All right, you've been waiting all your life for this. I'm kidding. There is a best trading strategy product. I don't know what to call it. Um, that to me is unbeatable in what it offers and the potential upside, the downside, and everything about it. So we're going to go through it, and I'm going to tell you why I love it. Let's go. All right, we're picking on Tesla. I'm sorry, my voice is a bit off. I've had, I don't know, they call it strep. Anyway, just sore throat. Okay, so Tesla, right? So most people, you're either buying stock, selling stock, right? And if the stock goes nowhere, you make nothing. If it goes down, you're losing. This is if you bought the stock. And if it goes up, you make however much. But there is another way. Again, it involves the option market. Don't be afraid. Don't think, oh, I'm never going to trade options. It's really quite straightforward. So go into our broker. Here's our options that are on offer. And so for me, for example, I'd go for 65 days. Why 65? Well, a option contract, I'm going to try and keep this all really simple. So I'm assuming this is people that don't know anything. An option contract has a timeline. So in 65 days, the options in here will expire. And you'll either get paid or you won't. These ones go in 9 days, 37 days, 65 days. So 65 days I would go for because the time decay on the option, so for example, all these here are out the money and will expire at 0. So if you were to sell any of these, you would make, say for this one, you'd make the $18. For this one, you'd make the $33. So if you sell them, the time decay of these eventually goes to 0. And if you picture it, so when you're a long way away, the prices are like this, and as time passes, it sucks in, and then gets lower and lower, and in, and tighter, and eventually goes to 0. That's the beauty of options. And so, how are these options priced? Well, again, just trying to keep it simple, and we'll just so I would only ever, so we're on the put side, this side over here is the put side, this side over here is the call side. It's just an option, don't be scared off. And for me, if I was beginning, I would only look at this put side. So what does it mean? So let's say we go, right, here's the 25% chance option here. So let's say we sold that option. So it's gone red because it's a sale. If you were to flick it around to buy, it would look like that. So $18, we want to go, your max profit 1,815, max loss 27,000, and it wants from you 6,240 in I think Americans would call it collateral. I'd just call it like money down. You got to put down 6,000 to potentially make 1,800. And even though you might lose 27,000, you don't have to put down that much. So between now and the next 65 days, see this green marker here, if it stays above 290, anywhere above 290, even if it drops down to 295, at expiry, you're going to make all that money. That is why I love either you could call it the short put trade, and if you don't want to lose 27,000 because you haven't got that much, you can just above where you've sold, you can buy an option, and that then limits you to the difference between these two. So now you can make 330. Notice how much that's gone down, but your max loss is 670. So if you're a beginning trader and you're stuck in a few grand, you might opt for this trade. Now the beauty again of options, as I've made another video about them and how they literally tell you the probability of this trade happening. So the probability of profit 65%, and the probability that you'll get 50% of the 330 is 79%. I mean, if you love maths like I do, there's nothing finer than maths. How is that not perfection? That you get told literally the probability of your trade happening. So you can move these around. So you can move that one up. You can see how you make more, but you get a bigger loss. You can suck it right in to be max profit of 170, max loss of 320. We can play around with these options. Notice we're inside this brown line, which means we're inside the expected move. If you believe it to be incorrect, the expected move, say on the chart, you're like, oh well, because of support at the 270 price. If you're into technicals, maybe you'd be much more comfortable selling, say, the 260 down here because you don't believe that something will get lower than that previous low or whatever technicals you want. So you could sell the 260 up here, get rid of that one, and there you go. So you've sold the 260 put. I don't know why it keeps coming up market. So you're going to make $960 in 65 days. Your max loss, if the stock goes to zero, is 25,000, and the broker wants 4,600 for this. So a lot of people would put in the opposite side, and then they'd flex this to have the downside according and the upside according to what they're after. Can be anywhere, like I don't know. Make 200, max loss 800. So you're going to make $200 if Tesla stays above 260 in the next 65 days. Why do I love the put spread and just the naked put? Well, when stocks drop like this, the implied volatility goes up. What does that mean? That means that the prices here lurch higher. So obviously you don't want to be in a trade, but if a stock has a like sharp drop for one day because President Trump says, I don't like Elon anymore, which I think is exactly what happened here. They had a tizzy fight in the White House, so the stock dropped on basically a nothing. You could then quickly jump in here during that vol spike, sell the 260 put, probably for double that. I don't know. Actually, I might be able to see what the price of this was. Let's get rid of this leg. I think view option in chart. Yeah, here you go. So yeah, it was way higher. The price of this option got up to 60, and then just over. I know this is it's just a few days ago. So it's this one actually. I think a couple of days ago it spiked up to 30, closed at 24. So you could have sold it at much higher prices. But that's the point. If on that day when Musk fell out with Trump, you could sell that because it's overpriced basically. And when that falls to zero, all the stock price has to do is stay above that mark. So it is my favorite trade. Everything's in your favor here, because if the price of a stock falls, volatility expands, that's your chance to place the trade at a much lower price than the stock's currently trading at. And then as it recovers, that's when all that volatility comes back out of the product and you make a very quick profit. And even if it doesn't come out of the product, all the stock has to do is stay above that price, which sounds easy maybe, and maybe that's maybe my point, that it is a little bit easier than trying to predict the movement of a stock, but that's the point. When you get these sudden downdrafts, there's a spike in volatility, and that's your chance to sell the options contract. It's kind of my go-to bread and butter. It happens all the time. And Tesla, especially right now, with all the tweets going on and everything, it's a target-rich environment. I hope you like the Top Gun reference. So if I was learning to trade, if you were my son, I'd be like, boy, look at this put side, get to know it back and front. When a stock drops and the implied volatility spikes, jump on this put side, sell something. If you don't like how much downside it is, buy a put further up the chain, limit your downside, and literally you'll just watch that these prices drop. Not just because of time decay, and not just because they're so far away from the current price, but also because of the implied volatility leaving the price of the options. I hope that's useful. If you're new to trading, might be a lot to take in, but I've just tried to stay to I haven't talked about obligation this and obligation that and all the stuff people seem to go on when they're looking at options. Just keep it real clean. It's just, will the stock close below 255 in 65 days time for Tesla? That's all this means. And if you don't think so, you can sell for, you can make $860 by selling that options contract. It's a beautiful thing. All right, that's it.